It's a great pleasure to welcome Adair Morse to Stockholm today to talk about impact investing and sustainable finance. She's a world-renowned expert on this topic. She's a professor of finance at the University of California at Berkeley and also served recently at the US Treasury as the Deputy Assistant Secretary for Capital Access. So today we want to talk about, welcome to the Stockholm School of Economics and the Swedish House of Finance. Of course, it's great to be able to talk to you about this very pressing topic. And I want to start out by actually asking how you got interested in the topic and how you got started on it. Now there's real buzz around this topic, but I guess my guess would be that when you started working on the topic, that wasn't the case. So what made you interested in it?
Yes, thanks, and it's lovely being here, so thanks for having me here. So I wish I had a great answer to that question. The truth is, I taught venture capital at first the University of Chicago and then at Berkeley, and in teaching how new ventures get financed, and you're in Berkeley, the students brought this subject, right? The students brought the things that they were doing were things that at the time we didn't care about in terms of big finance, right? Then, like food and agriculture and outcomes of labor related to venture capital. And if you listen to compelling stories, the role of financing things and how the outcomes actually matter affects the returns on investment and affects society as a whole. And so it just brought the issue of what are we doing in finance as researchers, and how can we combine things we personally care about with big research that speaks to financial returns and other outcomes. And so it was very much talking to hundreds of startups every year in the Silicon Valley ecosystem, and where the trends were going in terms of what they cared about, and as a society, how we move together and what is business education. So I can't take too much credit for that.
So at this point in time, what were the major themes in these conversations that you were having with both students and people from the industry? What were kind of the key drivers?
Yeah, I mean, so we were, there's a bit of, we're coming out of a time period in the early 2000s, or the end of the first decade, and there was a view that maybe finance is not the coming out of the recession that had a lot to do with the financial ecosystem in real estate and others, and so what is the role of big finance? And so the pressures and the point in time was really about, but what is the role of finance? Maybe our nutrition, maybe our how we handle thinking about conservation and the environment and outcomes that we care in nature. Maybe these things really do matter, and if rather than just negatively reacting to finance as a whole, but how is finance empowering? So that's what the students, they wanted, the ones that wanted to study finance, they wanted to be out in the ecosystem doing things in food and agriculture, which was an entirely new subject, and in a new subject in finance, and in environmental outcomes. And there was a bit of an education push as well, less so now as opposed to the first two. So still relevant today, all of those topics.
Now, finance has been around, the study of finance has been around for decades before this new emergent topic. So what's really new about it? Is there anything we need to know about it that we didn't know about before? So is finance, the finance that we knew before this new era, is that enough to think about this new era of finance?
Yeah, so it's interesting that if you'll allow me, let me take it to impact and climate, because I think this is where you clearly see how we can think about impact investing and the different perspectives. So in impact investing, I like to think of impact investing in that the word is too general. I think of it in two different pieces. There's impact investing where we know, and this is what I did research on, where we know there's a dual mandate, and maybe in that dual mandate, that the money in may already know that it might require a lower return relative to market, what we call, right? Then there's a large chunk of impact investing, which I wish, again, these had different names, where there's a different risk profile of the investments. And so then the overall expected return may be very similar to market. In fact, in expectation of taking into account failures and successes, that maybe those are the same. And so this is how people like to argue, is impact investing market rate or not? And I think we need to be careful with our labeling, because if I'm investing in something, an example you can give, education opportunities in a place where those opportunities wouldn't otherwise exist, and maybe there's some revenue associated with that, investing in that education, I'm probably not expecting market rate returns on that investment in those revenues, right? That's not why I'm doing it. I'm doing it because there's a need there for a public good of ensuring education for those children. That is very different, and how I invest and see my returns on that, as opposed to maybe I'm investing now in the climate space. So in this, as society, as we're moving into this and have been moving into this realm where there's a risk associated with older economy electrification, older economy use of fossil fuels for vehicles and other things, maybe there's a lower risk for an investment into the climate opportunities, or maybe there's a lower risk investment in to a company that takes diversified employees, having diversified employee base to understand their client base, right? These investments in impact investing with these metrics may just be a lower pool and market rate, but they may imply different nominal indicators going in terms of what the investors, who's investing in and where the opportunities are in this space. But I see those as very different. So you asked me, that was a long way coming back to your question, but you asked me, how do we need different metrics? I absolutely think we need to first to divide the types of investments and what the return space is. Is it a financial return, or are the investors themselves looking for back to the kids getting a quality education? Is that something? So we have to have those measures. The other, on this side, we have to understand the differences in long horizon risk profiles so that we can mobilize more and more capital toward the types of investment that have impact. But not just measuring the outcomes in terms of what we care about from a society point of view in terms of the impact in the environment or labor, but also the impacts on risk moving in so that we can mobilize this more private capital.
So I really like this distinction between impact investing that's concessionary and then the other type of impact investing that you suggest may deserve maybe a different name. But let me come back to this bigger question, which is, where is finance going to have play its biggest role? In which space do you see that? Is it really in the concessionary part, or is it in the part where returns and impact may be going hand in hand?
That's a great question. I think we need both. So I noticed that I avoid the word concessionary because it's a loaded term in the finance world. But think about, let me talk about conservation on this side, right? There's a need for biodiversity and conservation. Maybe it's that we need different partnerships to mobilize private capital to support the conservation attributes, to save species, to save certain parts of the soil or whatever it might be. And so those attributes that are needed here on this side, figuring out how to financially structure around them. with maybe there's government or NGO vehicles or other type of private benefits. For example, I was reading about a IFC, part of the World Bank, investing in a wool industry for sustainable, the way that the sheep were being grazed and so forth for the sustainable farming. And the investor that had the most benefit maybe is the upstream, the wool industry itself, the making clothing or whatever. So maybe there's a different benefit using the ecosystem here to get to outcomes we want for sustainability in our natural resources and other of those outcomes. And so that is very different than moving where we, how we think about that and mobilizing money. Your original question was, which do we need? Well, we definitely need to take care of that. On the other side here, there's just a tremendous need for private capital flowing into all things climate and the transition, supply chain security, things that are impactful for reaching different communities. When the pandemic brought to bear that certain populations were more vulnerability to shortages and of all kinds of items necessary for survival. And as we go into other, looking at climate effects and taking care of where the transition affects labor in different parts of the world, I really believe that the scope for scaling up impact investing defined this way is just not only tremendous but necessary to mobilize what we need in supplies and in labor for the transition beyond the role of big innovation. We need SME manufacturing, and we need labor training, and we need all kinds of things that are impactful. We just haven't labeled them that, but are part of the overall transition.
And in terms of the industry trends that you're seeing, there's impact investing, maybe in sort of a more narrow sense, is still somewhat a small industry, a small amount of the capital. So another way of asking the questions of what role does it, can it play, is also asking what's holding it back potentially. What are sort of obstacles of sort of scaling this part of the financial industry to then potentially unleash this impact, the positive impact it may have?
Okay, so I get to geek out a bit on this answer. But so we need capital stacks, right? So by that I mean there are things that we need to mobilize larger opportunities. So maybe some institutional investors want to be in this space. They want programs that governments or others are de-risking some of the risk associated with some of the things that are happening. And there's a lot of programs out there from different governments all over the world doing this. But we have to somehow, beyond putting those individual pieces together in financial structuring, we also have to pool some of it, because it's hard for the long horizon owners of capital, pension funds, large insurers, their asset side, other types of large investors, to be able to put small checks in. And so we need to do more pooling of these investments, labeling them in terms of the risk appetites. This is why it's so important to divide lines and understand really how we mobilize public-private partnerships and different things, so that we can continually focus on mobilizing the private capital to come in for conservation, to come in for climate, and for social justice goals and equality. And it's a great opportunity to make progress while we're facing the transitions, because governments are putting the money out there to help with the transition. And this means we can do more for equalization as we go along.
So there's a lot of work to be done and a lot of capital to be unleashed. Where do you see this going?
The impact investing of the future should involve helping communities everywhere to provide opportunities for labor and to help communities with transitions. So we in the government, we focus a lot of time on what we call energy communities. So communities going through different kinds of transitions and finding that new value asset that provides opportunities for future employment and to really build livelihoods. So is that impact investing? I think it is. I think we need investment coming in that helps households to regain that feeling of growth for themselves and their families and communities. I think we need impact investing for equalization across different types of populations that we have felt disenfranchised in countries. And we certainly need impact investing for the environmental changes that are happening with climate change and with the transition. And we should never forget the importance of labor in this particular transition. As you know, Al Gore likes to talk about needing 500,000 more electricians in the United States alone. And that's a big statement. And that's just one country. And so we need impact investing to bring all these things up and to bring up households across the world alongside.
So a lot of the topics that you mentioned that impact investing can have positive effects on, we would traditionally associate with the government as the primary actor in addressing these topics. So we come back, of course, always to the question: where's finance? Why is finance special? Why do we need investors to think about these and care about these issues relative to governments doing it?
Yes, the truth about this transition that we're in is we have to have private capital because there's just not enough government funds to get us through the climate transition that we're facing. And so that's one piece. The other piece is, though, because the climate transition brings new opportunities for revenues, the governments do not have to be paying for the whole capital investment for the transition, but de-risking opportunities and mobilizing that private capital, and then the private capital is happy to come in where there are opportunities. So this is, again, coming back to the role of figuring out how to do the structure so that the taxpayer is paying for what we need to do to mobilize that capital, but also knowing that the governments are taking care of getting that private capital to come in. Now, having said that, there's a huge amount of infrastructure investment we have to do as governments, right? That the governments have to go out there and take care of that the infrastructure is set up such that we can see opportunities come. And the government has responsibility to make sure that we are implementing the right kinds of policy to mobilize the transitions. And of course, each country has a different version of that view. But I think we're all in this together. And when this is definitely true in the way the United States and Europe talks. But when you talk about emerging markets, where there's the transition is going to affect people in the zones of the world where the heat and flooding and the ocean rise, these areas needing more impact investing, needing more participation of private capital alongside governments, we really have to focus on these areas as well.
How do you think about the division here? So you mentioned a few topics that the government may be in the right position to focus on, like infrastructure and maybe livelihoods you mentioned on the impact side. But maybe just to bring this out a little more clearly, what are the things, the topics you think that impact investors really have an edge and should focus on in this transition?
There's so many, but in this transition, there are many opportunities to help with bringing up new resource uses in sustainable ways. So if you look at the profile of impact investing in global landscapes, say again going back to World Bank, IFC type investing, or some of the larger impact investing funds, taking care of the circular economy with plastics, right, is a huge issue for the oceans, but also just managing waste. Then there's the agriculture transition and the use of resources and the preserving soil, in finding ways to help small farmers everywhere with the transition to find the opportunities and to do so in a sustainable way so that they can keep producing year over year and keep their revenues. Better use of alternatives in, coming back to the plastics, of alternatives from the biologics is also a huge area where there's a role for impact investing to come in and support ecosystems, to use different base materials where we can then provide communities that wouldn't have had opportunities before in an impact investing sort of way to participate in that packaging economy or other things. And I'm just touching on industries there. There's also a whole level of reaching, using impact investing to reach communities that are socially disadvantaged for some reason or economically disadvantaged for some reason, to be able to grab these opportunities and participate in the global transition, and create more wealth for communities in a democratizing way. So both of those, I think, there's a tremendous advantage from the transition in being able to do both the transition and a conservation and equalizing at the same time, which I think is a compelling case that we're going to need more impact investing, and we're all going to benefit by impact investing taking a big role in the transition.
I want to turn to research a little bit. You have contributed to this topic or engaged on this topic on multiple dimensions, including policy, teaching, but also research. The research on impact investing is really in its infancy, and you've been one of the first to study it. Where do you think are the pressing questions that researchers really need to address to also help maybe industry and inform industry on how to work on impact investing most effectively?
Yeah, the research on impact investing is narrow. Again, partially it's a terminology problem, right? That we have this view of what impact investing is, and it's kind of a mixture of different things. And at the same time, the finance research on sustainability is very much taken the big portfolio ESG slant and those conversations. And we're now just starting to, at the cusp of seeing where we're looking at real investment in firms and startups, which is the impact investing space, and thinking of, and even across different asset classes, like the natural resource asset classes. And we're starting to see what really is the risk profile. So if you're asking me where should we go, well, it's really about risk. What is the expected return profile of impact investing broken down into, are there opportunities that lower overall risk because they are playing in a new economy, where a brown investment might be playing in an old economy, for example, that's in the climate space, and understanding how the role of diversity of labor or other attributes that's typically the S of understanding firms, how that plays into a risk profile of returns. That's all, what I just said has all been in the public markets, that kind of ESG thinking of breaking down what's in this E and S and G, which is really the compelling case, as opposed to the private markets, and that thinking hasn't come over into the private markets. Of course, we have to be a little bit careful of language and what is really thinking about, the E and the S and G and how that the scoring metrics are really, it's really not about the scores per se, but about the underlying attributes of firms and what matters, and digging in a way that is a win for everyone to know these answers, and getting away from some of the politics, if you will, around the way we label things, but really just understanding what's good business, what's good risk profile, and how does that relate to impact that you're doing as a firm.
So it also sounds a little bit like emphasizing that a lot of this is maybe just finance and doing sort of good investments, which is thinking about risk and then new risks emerging in particular when we think about climate risks. So in terms of knowledge maybe created that we also need to teach and disseminate to the industry, what is kind of the key concepts that we really need to kind of nail down as researchers and as educators to inform industry in that respect?
So I think it's well said that we need to inform industry, and we need to also inform the investors. And you're right that the risk side, I keep emphasizing the risk side. There's also the measuring what you're achieving. And this has been, the impact investing community has been quite adamant, and reasonably so, about we need measures, because if you're going to invest in these industries and these firms, that this is picking up something we care about on the impact side. I also think the measures of impact, knowing where you're going, is also picking up a piece of the risk side. So it's a bit of combining and having the financial research combine what financial economists like to think about risk and return, right? And the horizon, getting that right. But without understanding the measures of what you're impacting, it's a little bit hard to quantify and to profile those things. So I do see that there's more here than just traditional finance in the way we think about risk and return, but that doesn't mean we're getting away from the core economics that the financial economists like to think about. It's just we do have to understand society and how there's the additional pieces of what some researchers call stakeholders, stakeholder welfare. There's also public goods and the government provision of taking care of basic rights. And so all of these things need to be embedded into the research and our understanding of the profile of impact investing.
Regulators have a huge role to play also in driving financial markets, in thinking and caring about these issues. Now, the European Union has been really at the forefront of developing policy, also very specifically on financial markets. Now, you've worked very closely with policy makers in the US. What's your thinking around what will be happening in the US? What are we likely to see in the US? Will we see a convergence, maybe in the adoption of similar policies, or will there be a very different approach to this?
Yes, the US policy environment around impact investing in the different subfields of impact investing, has sadly gotten politicized. I think that's not a surprise. As we move forward, and particularly again coming back to climate, as we move forward and the opportunities continue to play out, the economy goes through these transitions, I think it will become less politicized, and we can see how the regulatory environment really matters, both for impact outcomes and things everyone can care about, but also as well for understanding the financial risk and returns. And so at that point then, the policy, the US and the European policy start to converge a bit, and we're able to line up on the regulation of things that matter. At the same time, in the US, we have state level leadership over climate policies and that are really affecting the overall outcome of certain industries. When we speak of policy, usually Europeans like to refer to policy as being on the regulatory front. Of course, the US has been leading on recently on the policy that provide carrots. I think the carrot piece here is equally important as, if you will, the stick piece around regulations on environment and labor and certain things, not being negative on one versus the other, but just understanding that is the tool we have in the United States out and working. And we being positive on how that relates to getting everyone on board with where we're going in terms of making sure everyone has an opportunity on the labor front, that everyone's taken care of, that everyone has a equalization in education, and that we take care of the environment and climate. So I'm super optimistic that we're moving, and that we maybe have to have different paths to do the different pieces on the policy front at the moment, but we need to take care of the momentum around climate and around households having security and having basic rights. And then we also need to look to the globe as a whole and understand that the implications that our historic use of fossil fuels and so forth has had on everyone, and make sure we do the right things for global households as well.
Thank you very much for taking the time and sharing your insights on impact investing.
Thank you so much. Really appreciate it. Thank you.